Welcome to the Futures Edge podcast. I'm Jim Uriel, and we have Amelia Bordeaux of Exante Data. And despite the fact she looks 29 years old, she's been a market veteran for 17 years. Thank you for joining us, Amelia. Did you run today in the warm Florida sun?
Thank you. I will. I'm going to run probably after this podcast, and I have a race tomorrow morning, so that'll be great.
Do you really? Because I'm getting ready for a half marathon with my daughter, which I do. I have this thing with my daughters. If they ask me to do anything sports related, I say yes, whether my body's up for it or not. So in 3 weeks, I have to run a half marathon, and every part of my body currently hurts. So hopefully, just wish me luck.
You'll have 3 weeks. I think you can do it. You can do it.
Like 3 weeks, it's nothing, right? Yeah. So let's establish credibility. First off, in the last 2 years, what's the favorite TV series that you've watched? And this is an important question for our viewers. What's the best one?
I love Ted Lasso.
Oh, I did too. Ted Lasso was great, wasn't it?
Yeah, it's so funny, and it's so like kind of poignant. And I love London, so it reminds me of, kind of being in London in the trading days in London too. So.
That's a good answer. I forgot about Ted Lasso, but I also watched Game of Thrones in the last 2 years, and that was just pretty spectacular. Okay. And then what was the chess one again? Queen's Gambit. Did you like that?
Queen's Gambit. I love the Queen's Gambit, and I actually liked on Netflix The Umbrella Academy. I don't know if you saw that, but I really liked it. I did.
It was a little much for me. I tried it. It was, I'm not. So we found out, we've established now where we're at on these things. So let's get to markets, because I think there's a lot of things that have really been interesting lately. The yield curve, I want to talk about first. Inversions all over the place. This is always bothers me, because I do believe it's somewhat of a good predictor of recessions. But when you say a recession could happen anytime from 3 weeks to 8 years after it happens, and I'm being a little bit facetious, it's not exactly prompt. It's not exactly specific. Do you think it means a lot this time? And expand on that.
I think right now, the yield curve inversion doesn't mean a lot at this moment in time, because what we're seeing is certain parts of the curve, they're inverted. But what's really happening is the whole curve is rising, right? The front end is just rising faster than the back end. I mean, on most days, I'm not talking intraday or anything like that, but basically the whole curve is rising. And so I don't think it's pointing to recession right now. I think the big move up, or the faster move up in the front end, is showing you that, the market thinks that the Fed is behind the curve. And so I can't say that it's pointing, to recession right now, when rates have been so low for so long, and now finally they're moving up. The entire yield curve is moving up. Just parts of it are moving faster than other parts of it. It's not as if the 10-year yield is declining day after day after day. I mean, if we start to see that, then I would more call it like a true inversion. But that's not what we're seeing right now.
No, and I actually like that answer a lot. And I do think there's a ton of validity to that. So you don't believe that we're heading towards a recession? Do you think we can handle the inflation that we've seen and not have it be recessionary?
I think, the Fed does have to get it under control. And right now the market's pricing 50 basis points, basically, or more than 25 basis points, I should say, at every remaining meeting this year. And I think there is kind of two things going on. We have to look at household balance sheets, and they're in pretty good shape right now. Wages are rising. We saw today in the employment report, and we have to continue to watch that. So is there going to be any erosion in household balance sheets in the United States? Are wages going to go down, or employment going to go down? Is the back end of the curve for the mortgage rates going to precipitate a steep decline in house prices here in the US? Because that's part of, a large part of people's household balance sheets as well in the United States. So we do have to watch the state going forward of household balance sheets. And right now they're pretty strong in the US, and it's unusual to enter a rate cycle with balance sheets so strong so early on. So that's something that you need to watch.
You mentioned something. You mentioned house prices. And we've seen a precipitous fall in house prices once, 10 years ago, and we've seen the bubble bust of the tech stocks too. And the one things that seem to characterize those, and people ask me this all the time, are we going to see a big implosion in house prices? Well, no, because before the Great Recession, we saw years and years of this huge buildup where, your brother-in-law, who's a plumber, says, oh yeah, by the way, I have 5 houses I'm rehabbing and it's planning on flipping. Anecdotally, I'm not seeing that at all, where people are way extended and average Joe's. Yeah, BlackRock has bought a lot of houses on leverage, but that's not weak hand leverage. There's a big difference, right?
Yeah, there is. And I'm not a housing expert, but I just recently bought a house here in Florida, which was not an easy thing to do. So I've been watching house prices very closely. So I don't want to seem like I'm talking my book, but when you look across the United States, the shift to remote work, obviously in the pandemic, has really changed the demographics of where certain people live who had jobs that were able to work remotely. I know not everybody has that type of job, but that has led to an increase in housing prices and inventory shortages in certain areas of the country where there was more of a migration, a domestic migration into those areas. And so we're not facing, I don't believe, like we were, the last recession with the collapse in house prices, because there really is an inventory and land shortage across certain markets in the US. But saying that, house prices here in Florida, my dog is agreeing with me, do feel toppy. And, the mortgage rate rise has been really steep. I mean, I think that when I got a mortgage in January, I locked at like 3.37. Now it's 4.67 today, the 30-year fix. So it's a big increase since January, but we haven't necessarily seen the start of house prices coming down in a meaningful way. And so, house prices coming off isn't the same thing as house prices collapsing, but it's definitely something to watch. At what point will the 30-year rise start to really bite in a meaningful way house prices? That hasn't started yet.
Yeah, I'm not, because prior to 10 years ago, and I'm a little older than you and have seen real estate for a long, long time, we never even considered house prices going down. That was the whole thing in The Big Short, is that, house prices never go down. You're betting against the U.S. housing market. You're absolutely insane. So I can't decide if I think house prices are going to go down or they're just going to level off when mortgage rates become somewhat oppressive. But back to Florida, you said in certain markets, and Florida, I assume, is what you mean. That's where the world is going. And I went there looking for real estate twice this winter, and I've decided there's just no way I'm not chasing price to this. Yeah. So feeling toppy and feeling ready for an implosion. I don't know exactly where I'm going with this, but I don't know. What I'm saying is I don't agree with you. I think that what we're going to see is house prices topping off. Do you think that when you say pullback, like what precipitates pullback? Are people going to start selling homes that they've bought?
I think what could precipitate a pullback is just mortgage rates get buyers for years now, right? Have been used to low interest rates. Like we haven't seen a 6% mortgage rate in I don't know how many years. So when we see that 6% mortgage rate, what are buyers going to do? I don't know. I don't exactly know how this set of buyers now is going to react, especially first-time home buyers. That may just completely put them off, or it's a
and they just back off their bids. Okay, I get what you're saying. So, right. Okay, let's talk. You mentioned the work from home. You mentioned COVID, the pandemic. At Exante Data, are you doing research involved in different aspects of the pandemic? What do you have that's interesting that you can share of developments recently?
We did a lot of research over the pandemic on COVID. We were one of the leaders and one of the first in the market in kind of using alternative data and all the COVID sets and putting those together to help our clients. Right now, we had kind of backed off it because after Omicron kind of receded, we thought, maybe this is it. What we're looking now at our COVID data is mainly in China. So, China had been gradually moving to they had moved away from like a zero COVID policy. They had started to kind of move away from that. But they have a large outbreak now, and they have a lockdown in Shanghai. And so, we're looking at that, the length and the severity of any lockdowns in China to combat COVID. And what the impact will be on global growth and China's economy slowing, what the impact could maybe be on supply chains if their factories have to, shut again. And obviously there's a supply chain issue everywhere and how that will impact it. So that's kind of what we're looking for. Recently within the past month or so, like Australia really reopened their borders to international travel. So the other aspect is COVID related, but the other aspect we looked at is the reopening of these borders throughout Asia, because they had been lagging. Obviously borders have been open in North America and in Europe, but they really started to open the borders now in Q1 of this year in Asia, and that commenced Asia travel. So we're kind of looking at it from a tourism perspective, a rebound, say for Thailand and for the countries that matter for tourism.
So you say more good news than bad news, despite the fact that China's locking down again. There's more places open up. So on balance, it's better news than worse, correct?
Well, there's more places open up for the tourism sector. I think, yes, it's better news for that sector specifically, and the airline industry, throughout Asia. But China's such a large economy that should these lockdowns become prolonged or involve more cities, that we'd have to look at it from a global growth perspective at China's economy. But so far that hasn't happened. The lockdowns are only, a couple cities locally.
Okay, so here's this. You mentioned supply chain. And I want to know what you honestly think and where blame is to be placed. And I know it can be sometimes a petty characteristic of mine, but I want to place blame here. You look at the rampant inflation that we've seen, and I'm sure probably what my opinion is on this too. But you have the Fed keeping rates, zero for so long. The Fed buying mortgage bonds into the teeth of just a raging housing market a year ago. You have the government spending tons of money. You have the supply chain issues. Now you have the situation in Russia. What are the primary drivers? And can't say all of them. You got to list them. Give me something here. What are the more important drivers of inflation here, and what needs to be rectified for it to fix it?
I think it's tough. I think it started before the war. It started before, I think the massive ramp up in house prices. I think it's just kind of the second round effects of the initial inflation with the supply chain. It kind of got embedded in wages, right? So once that initial inflation goes to the second round, gets embedded in wages, it then becomes embedded in inflation expectations longer term. And that's what you're kind of seeing, I think, in the United States, inflation expectations moving up. And Powell has spoken about this many, many times. Once long-term inflation expectations start to move, that would be a catalyst for the Fed to, I think he said something, change their views or start raising rates. And, I think that they had maybe started to become more embedded in longer term prior to maybe them showing in the surveys that, now the Fed is, most people think behind the curve. And that's why we're seeing larger rate hikes priced throughout the rest of the year. And I wonder, and we wonder at Exante Data, where that peak rate will be or where that terminal rate will be for the Fed funds rate. So we actually think that, we may see more rate hikes priced late 2023 into 2024.
So was the dog barking putting an exclamation point on
that? He was, that's Bondi. You know what, this is a good story. Bondi has been with me. Bondi is a Maltese. I'll get him over here in a minute. He's wandering around.
Please do, yes.
He's 18 years old. And he's been with me since my first job on Wall Street on the trading floor at Deutsche Bank. So that's when he's seen me through my whole career. I'm going to go get him.
Well, I trust. Yeah, go find Bondi. I trust. What is Bondi? What does that mean, that name?
Bondi, he's named after one of the world's greatest beaches, Bondi Beach in Sydney, Australia.
Oh, I've heard of it. I genuinely have. That is cool. This is the most exciting part of the show where we show our dogs. I will show you a picture of my Payton at some point in time too, who's named after the greatest running back to ever strap on a helmet and shoulder pads. Oh my gosh, here we go.
This is Bondi. He's 18 years old. He's been with me since my first job at Deutsche Bank. Deutsche Bank at the time was on Wall Street. And I got him from a broker who he's from Florida originally. The broker had taken him from the breeder and brought him to New York City to find a home. And she was living on Wall Street in an apartment. So on my lunch hour on the trading floor, I got someone to cover the desk. I ran out and I ran a couple blocks down to the condo that she lived in. And that's where I saw Bondi for the first time 18 years ago. And he's been with me ever since. So.
Fantastic. Yeah. That's outstanding. I love dogs. I've always usually had two dogs, but right now I only have one because we lost one about a year ago. So I have like a old mutt that I post pictures of her on Twitter sometimes. She's gray all over the face. Her name's Payton, named after Walter Payton.
Yeah, Walter Payton.
Yeah, you do know Walter Payton.
I used to be a Bears fan. This is a long time ago. Like what is the Super Bowl shuffle team, right? That one.
Exactly. Okay, good. Okay, back to markets for a second, because I don't want to lose track of something that you said. I don't know if you saw the JOLTS numbers from a couple of days ago, but quit rates are very high. Wages are going higher. The people who quit got average 6.6% raises. The people who didn't quit did not get as much, 5%. So wages are going higher. Wages are not keeping up with inflation. You mentioned Powell. If the wage thing starts to grow more aggressively, that puts us in a terrible predicament with inflation, right? Because then we're getting that wage push inflation where it's much harder to derail, correct?
Correct. It puts us in a more difficult place for inflation, but it puts us in probably a better place for household balance sheet. So you have to ask yourself, remember going into this rate hiking cycle, almost a recession, going into this rate hiking cycle, that's not what I meant to say. Okay, so going into the rate hiking cycle.
Which, by the way, I believe there's going to be a recession too, so perhaps I planted that seed. Yeah, I know.
How long can these household balance sheets hang in there? So if we continue to see wage gains, so maybe people aren't out there taking vacations or driving because gas prices are so high. So maybe they're going to retrench from that services spending or going out to restaurants because food prices are so high. But if they still have a job and their wages are still rising, maybe, they're going to come through this okay, especially if house prices, level off or come down, don't collapse. So you kind of have to look at the moving factors, I think, of the household balance sheet.
Okay, which something that you mentioned was demand destruction, and particularly in gasoline prices. Historically, $4 a gallon was viewed as the spot. I think I learned that from Bobby Iacchino, our co-host and friend on this show and producer of the show. But this time that it blew through $4 and it didn't seem like demand destruction was happening. Is there a different level? Are we numb to high prices on the short term? And is there a different level that you think that discretionary purchasing of gasoline is going to start dropping precipitously?
I think this cycle is so different from other cycles. And part of it is because people have literally been, I don't want to say locked up, but we've all been home for 2 years, right? In varying degrees in varying parts of the country for varying reasons. Like maybe we wanted to go out, but nothing was open, So, now is kind of like the first normal summer, I think, for, the past 2 years where everything so far seems on track, health and pandemic wise, like, hey, everything's open, we can travel. Mask mandates are being lifted. Everyone feels maybe a little bit more comfortable than they did last summer. Because last summer we were still getting vaccines. Vaccines had just started, for various states had different rollouts and things like that. So people were still getting vaccinated last summer. That's really not the case this summer. That's kind of over and done with. And so I feel like people thought they'd be more free to travel. And now here comes the high gas prices. And so maybe people are saying, despite the high gas prices, I'm going to go anyway. You only live once. So maybe there's a little bit of that. And so it's harder to find that level of gas prices per gallon that's going to cause demand destruction. And as I said, if people have a job, they may be willing to spend more to travel right now, just because maybe they haven't been able to the last 2 years.
So you gather data, which that's what I do too. I love data. Now but I'm going to ask you a question now. I just want your gut. I want an honest answer. And you obviously nobody has a crystal ball regarding the pandemic. Do you think 3 months from now, 6 months from now, is this really behind us? Are we out of this? And this is just, again, this isn't your market analyst hat or my market analyst hat. What do you think?
Out of this meaning the pandemic, or out of this
meaning? Yeah. The pandemic. You're going to say, I hope so. You're going to say, I hope so. That's not what I want. I want you to give me an honest opinion.
I think yes, because the latest variant, Omicron, that we saw here, when I mean here, I mean across the United States, was milder compared to the previous Delta, the previous variants. And so it caused a lot less hospitalizations. And so I think that that's a hopeful sign, that I think that the variants won't necessarily disappear, but as they pop up, they will be, they will be less potent and cause less hospitalizations, and it'll just kind of become what they call, I guess, endemic. It'll be like the flu. So it's not going to be the big pandemic that it was the last,
Right. And again, this is, neither of us are doctors. For people who are watching here, this is just two people talking. We're not experts on television shows either, but we both like Ted Lasso. And I believe it's over too. I had Omicron, and it was a nasty, 24 hours. And I know a lot of people who have it right now. It's in Chicago, and maybe because the weather's the way it is, we're still in winter here in Chicago. But I do know there's quite a few people who I know who have COVID right now. And it seems like the worry about those people ending up at the hospital, like it's waned quite a bit in people. So I hope to God, again, this has been, an awful 2 years for a lot of people. And I really hate so much about it. And I hope it's gone too. Who Jim Bianco is? If you don't, he's a fabulous analyst. I was just reading a piece by him, and I'm trying to bring this back to markets right now and back to inflation. And he's talking about the supply chain. And it's something that I thought was very, very interesting that I want you to comment on too, before we let you go. He's talking about the shift from work from home. And basically, if I'm reading him right, he's talking about an economy our size, any shift at all. Our economy is built, like, metaphorically, for people to drive from, Chicago to Milwaukee, from Chicago to St. Louis, and the roads are built for such a thing. But when we shift and people's habits are shifting, and you go from living in the big city to working from home, even if it's this minor shift, the entire economy and the entire supply chain was built for this. And now we're getting this. And there's people who want things shipped to Florida and things here. So it's going to take years to rectify those supply chain issues, to get it as finely tuned as it was. So does the supply chain issue linger for many years like he thinks?
I think it can linger. I'll tell you a story here. I'm currently in Jacksonville, Florida, and Jacksonville, Florida is interesting because for 2021, the numbers have just come out from the Census Bureau. It had one of the largest net migrations domestically of any city in the United States. So I think we were number 3. I think Austin, Texas was number 1, and maybe it was Dallas was number 2. But anyway, Jacksonville was number 3. And what you can see here in Jacksonville since 2019, there has been an increased pickup in traffic, a housing shortage, rents are going through the roof. Like, there's not enough grocery stores for the people who moved into the community. Like, the grocery store building hasn't kept up with the house building and the people moving into places. So, you're seeing traffic being rerouted, and and so there's construction projects going on around traffic, construction projects going around grocery shopping and parking for the grocery stores. And all of that is really just at its beginning stages because the population increased so much in the last 2 years that everything else kind of hasn't kept up with it. So to answer your question, yes, I think in certain cities in certain regions, that's definitely going to be the case. You're seeing like local supply chain issues are going to be hampered for the next couple of years because you can't just, grocery stores just don't pop up in, 2 weeks,
So what's just so fascinating about the migration story is that, if you're a historian about this whole thing, because it really began 60 years ago when cheap air conditioning, when Carrier invented air conditioning. So the migration from cold to warm started, but it started slow. And then there's also a sub-migration going on within states, going to like college towns were starting to become the cultural centers. So those migrations were happening. So then all the warm weather states started to take advantage of it by offering tax incentives to go there versus the old stodgy northern states. And then all of a sudden we hit the pandemic. So it's like everything cascades into once. And it's a tremendous deal. And it's something that's not changing anytime soon. Why would you live in Illinois and pay 3% of your home's real estate prices where you can live in Florida and pay much, much less? I don't think this is anything that's going to change quickly. And I think the supply chain is going to have to really, really reinvent itself to supply that.
Yeah, I know some of the Florida ports are, trying to capture the California ports are quite backed up, and Florida's trying to have, some of that rerouted to Florida. So yeah, it's interesting, all of the logistics that are definitely involved.
It's crazy.
I think the other thing I wanted to touch on quick just was equities. I just wanted to make the point. Obviously, we have, unfortunately, the Ukraine-Russia war that's happening. And one of the things on our radar screen at XMT, so I just wanted to call attention to it, is, we've seen some flows out of U.S. equities. So that kind of end of U.S. exceptionalism in terms of the last 2 years and all the money that had gone globally into U.S. equities is kind of waning a bit. It kind of came back. We watched capital flows very closely at XMT, and we have pretty timely data. So the U.S. equity flows have actually come in a little better the last couple of weeks. But I think that just on the radar screen, it's hard to know when and if it'll happen. But if there is a ceasefire or some sort of agreement that the war ends with the Ukraine and Russia, you may see a rush into European equities because they fell more than US equities have. And I wonder what that will mean for US equities, if there'll be further diversion out of US equities to Europe. But that's just something on our radar screen. Should a ceasefire occur, we're looking for maybe a base in the euro and also European equities to start to recover.
So if you're saying, and I don't think you are, but if you're saying that if we see a ceasefire, you're not saying that the outflows from US will accelerate and then our stock market will suffer. You're just saying that Europe could outperform in that situation, correct?
Yeah, in that situation, Europe could outperform, but there have been, some outflows from US equities. So it'll be interesting to see if we'll see more outflows from the US into Europe, or, we'll kind of see a more risk-seeking environment where maybe Europe will just outperform the US. But so far, in Q1, as from the start of the war, Europe has underperformed the US. And so you would think that would reverse should there be a ceasefire in terms of the equity.
Okay, last question, also about equities too. When you look back at the first quarter, this is the end of the first quarter, right? Do you think the bigger punch that equities took was from rate policy readjusting, or was it from supply crunches specifically tied to the war in Russia and Ukraine?
I think it was a combination of both. I know you've heard it before, your equity markets hate uncertainty. And once uncertainty starts to creep in, you kind of had the rumors. You had the troop buildups, right? You can look on Twitter at kind of these private satellite companies that release, these images, and they're unverified, but they're starting to release images, early in January of the troop buildup, right? I live here in Jacksonville where there's a giant naval base, and the ships were starting to go out in January, and it was starting to make people nervous. You had that. And at the same time, you had all the talk about inflation and supply chains, and that was making people nervous. And, here in Florida, just buying a house, and the housing market's strong here in Florida. So what are people doing like me? We were trying to buy furniture in Q1. Impossible to buy furniture in Q1. I mean, they're telling us, I wanted to buy a couch. Literally last week, they were telling me it's a year wait to get a couch. I mean, so when you hear that, when you just go to a store and people are telling you, I don't have anything to sell you, that makes you nervous, right? You're like, that's not normal. And so I think all of those factors, did come together because equities just don't like uncertainty.
Amelia, I haven't had a goddamn dishwasher in my kitchen because we can't get the motor. I haven't had one for 6 weeks. And I keep sending messages to GE and to Grand Appliances to send some schlub over to wash my dishes so my wife's not in a crabby mood every night. But this is an amazing world we're living in right now that you can't get your dishwasher fixed. So this is, I'm sincerely hope these things change relatively quickly. But the supply chain stuff is messed up.
It's like first world problems, right? But they are... Okay. They are problems that we don't usually encounter, and the fact that we're starting to encounter them means there's something off in the economy, right? It means there's
but when my wife gets angry, that does not feel like a first world problem, Amelia. It feels very dire.
It's very personal and immediate. It's an emergency.
It's an immediate emergency. Thank you so much for being here. This has been a lot of fun. This is Amelia Bordeaux, who is Senior Advisor for Exante Data and a longtime veteran of markets. Thanks for being here. It's been a lot of fun.
Thank you. And thanks to my junior analyst, Bondi, for joining
us. I wanted to pick Bondi's brain a little bit more, but next time we'll do that.
He's asleep already. That was a lot of
he's 18 years old. Give an old guy a break. He needs his nap.
I know. He's retired. All right, take care. It was nice speaking with you.
Hey, good seeing you too. Right. Yeah. So, Bobby Iaccino, we saw this week, actually yesterday, the release of the SPR, million barrels a day, which seemed suspicious to me, the timing of it, because it almost seemed like he was saying, I really think we're in a dire emergency. We need to release the SPR between now and the first week of November. It seems like maybe that the emergency will be gone the first week of November. Is this a political stunt or is it real? And what's the implications?
All right, a couple of things. First thing, it reminds me of we're going to do emergency vaccine mandates starting 6 months from now. That's what it reminds me of. Okay, that was one of the weirdest parts about the vaccine mandates, but enough of that. From a perspective of crude oil itself, we've seen crude oil fall, but one of the things you have to watch with crude oil is the curve and not just the front one. And the curve is not reflecting that this is going to make that much of a difference. And I'll give you one key data point that I like to look at when discussing demand of crude oil. Obviously, you can go to Statistica or EIA or IEA, and it looks like demand is recovering almost to pre-pandemic levels, but not quite. What I like to look at is refinery utilization, because it is just a quick note of how much the refineries are trying to operate or where they're operating at. And we just spent one of the longer stretches of time below 90% that I've seen in quite a while. For the last 3 weeks, we've had 90. So we had 90.2, 91.2, and today was 92, I believe, 0.8. So refineries are starting to pump out more product. That's because demand on the ground is rising. Now, it's not a foolproof indicator, but it's kind of a foolproof indicator because it's literally demand for refined product. What the do we care about crude oil? It's the refined product we want. If it's not getting refined, it's not that useful, unless you live in little Brea tar pits. So from a perspective of it, we're looking for refined product. We're starting to see that demand. The SPR release, the refineries still haven't gotten the 60 million barrels that they released or announced they were going to release. That hasn't even gotten to refineries yet from the people that I talk to. So this is definitely a down the road solution. It's also a down the road problem because now they're going to need to replenish it. There's actually a congressionally mandated cap on the SPR, and we've been at it for a while. Why we have that, I don't know. But now they're going to need to replenish. They're at about 707 million barrels last time I looked. So if they release the full 180, it takes them to what, 547, somewhere around there. So now you got to replenish that. That puts a floor in crude oil prices later. So it's a super interesting dynamic. It kind of keeps the price of crude oils in a wide range, but higher than it would otherwise be.
Okay, so and you and I are both market guys. We've been trading these markets for a long time. And one thing that I was impressed with, and I don't know if it was skill or it was luck, if you are going to manipulate the price of an asset, not that I know about manipulating the price of an asset, but let's just go back to countries that have been currency manipulators forever. And crude is a it's been somewhat of a cartel-driven market. Somebody can be suspect. So they seemed to wait for crude to begin to go lower on its own, and then made this announcement. That seemed really smart. That's the way you do it. You wait till the momentum starts in your direction and hit it, because then you have to think there's people sweating their lungs going, shoot, when am I going to get out? And then like, oh no, we got to head to the exits. Was that intentional, you think, or do you think it was just dumb luck?
Well, I hope it was intentional, because it's a smart way to do things. You and I remember when the Bank of Japan would go against the market and buy yen in the 90s, and it would fail every time. Every time. It'd be a temporary move and then it would fail. And they learned their lesson that they actually have to go in the direction of the market. They have to wait for a natural fundamental move before you can actually, let's call it nudge rather than manipulates the markets.
Manipulate is a terrible word. Let's say nudge.
It's awful. Yeah. It's not accurate at all. But so from a perspective of that, I hope it was a smart move rather than dumb luck. Because I hope they're actually they have maybe some market savvy people in there saying, okay, this is a good time to announce it because we've had a little bit of a dip now. So I hope it was deliberate.
Okay, now let's trade it. Let's put our money where our mouth is. What do you think?
So here's the issue. As much as I want to trade, if I want to trade crude fundamentally, I want to get long again, because this is a temporary fix. And like I said, the floor is in it, but I can't do that with the price action. So unfortunately, I have to give you kind of a conditional trade. And we do that sometimes. People have to realize that your money doesn't have to go into the markets right this second.
No doubt about that. People need to learn. That's the most important thing for people to learn is you wait for your opportunities. Yes. Sorry to interrupt.
Trade the good trades. You don't trade for juice. You don't trade for excitement. So I'm looking at a daily close on the front month crude oil contract below 93.53. If that happens, then I can get into a short trade. It's likely there's going to be a little bit of a panic there. So then I'm going to wait for what I think would be a rally back to 93.50 or better. Now I'm saying a close below 93.53. So if the next day it opens at 93.52, I'll sell it. Okay, but my guess is when it gets through there, it's probably going to close more like 92.90, something like that. That's too low. So I'll wait for a rally back to around 93.50, and I'll be looking for a move down to about 86.05. I'll put a stop at about 99.50. So now people may be, well, wow, that's $6, right? That's a lot. Not with the micro crude. And this is the beauty of the micro crude. I'm going to do this in micro crude, and I'm going to risk $600 per contract with a possible $645 profit per contract. So if you're a bigger account, you could do 10 of them. You could do 5 of them. If you're a smaller account, you could do 1 of them. Essentially, I'm going to frame this as I'm risking 600 to make 745.
No, and I like it a lot. And when you mentioned the micros too, and that's the thing about them, is just flexible. You know, so like for instance, we're going to talk about Bitcoin in a second. The Bitcoin futures contract that was 5 Bitcoin. Okay, yeah, that's great for big institutional. But if I just have a mild interest in it because I'm looking at a bunch of different things, I'm not going to put on a 5 Bitcoin contract and wait for that to move $5,000, and all of a sudden I'm down $25,000 on a Monday before I've had my coffee. The micros are beautiful for that. Yeah, you put on a couple of the micros, gives you flexibility to take some off when you want, and it's great. Now that was my intro to talk about Bitcoin. Okay, so this whole year, starting in January, Bitcoin had been between $45,000 and $35,000, and it seemed relatively happy to stay in that consolidation area. And people will look at it and be like, we're talking $10,000. You know, it's a band. But yeah, it's Bitcoin. Bitcoin it's a relative calm compared to its volatile history. A couple things happened in the last week that make me very interested in it. Russia in January said, we're coming down on Bitcoin. We're regulating the crap out of it. We're going to put you guys back to the Stone Age. 2 months later, all of a sudden, when chaos starts to happen, the chaos that they caused, all of a sudden they're saying, yeah, we're maybe thinking about accepting Bitcoin in exchange for oil. That's a big, huge pivot for me too. Bitcoin seemed to rally on that. Bitcoin seemed to rally on Japan, saying essentially unlimited QE to keep 10-year yields capped at a quarter. So it broke out of that range. So I'm a big fan of that. What are your thoughts? So
I have a bit of an issue with Bitcoin. So we're recording on April 1st. All right, this is afternoon Friday. Markets are closed. Bitcoin had a really nice recovery today. That's
what I was going to get to as really well. Nice yes.
I sold all my Bitcoin on Tuesday. I sold every crypto holding I had this week, Tuesday. And the reason was I read about something that the EU Parliament was looking at, and they passed it yesterday, and it bothers me. The 2 greatest things to me about cryptocurrencies, privacy, one, and decentralization. Decentralization, probably the main one, but privacy is a big one to a lot of people, especially considering what happened in Canada. We don't have to go into detail about it. Also, quite frankly, without taking a political stance, the idea that the West could just pull a sovereign nation out of financial system, it's a tiny bit scary. The EU just passed legislation, the Parliament passed it, that every crypto exchange has to report transactions over 1,000 euros. That includes transactions coming from privately held wallets, and they have to report who did it and when, their address, their social. I don't know what else they have to report, but essentially privacy in the EU in crypto transaction is dying, if not dead. That bothered me a lot. Now, again, we had a good recovery today, but prior to that, we had a couple of days lower, and I think it's probably on that announcement. The technicals to me look good in Bitcoin. So I'll still trade it, but I'll be interested to hear the way that you want to trade it.
So I'm long it, and you know it. And I've always talked about this for the last 2 years, that I haven't been comfortable enough to trade Bitcoin and Ethereum, but I have been investing in it, if that's what you call it. I have a regular weekly purchase of it. It comes every Wednesday. The reason I mentioned that is because it's random. I don't care what the price is at a certain time on Wednesdays. And it went from being a little bit of money to being a lot of money. Bitcoin's rallied quite a bit. Now I'm considering trading it. And today's price action, and again, Bobby knows, and you know that I consider myself 60% technical, 40% fundamental. It's probably more like 70-30. And I love when fundamentals back up my technical thesis. But we talked about it moving out of that range. And then what Bobby said too, when it went back and tested that range and went below it, and then rejected it soundly and rallied higher. I like that. I thought that was an indication that short term, it could have some legs. So I'm going to talk about the 10-year trade after this and actually havent. this is a Bitcoin trade that I haven't put on yet, but I'm considering putting on. And this one thing we're going to be on this show is absolute honesty. I'm not going to act like I got $1 billion position on something that I don't. The one time I went to trade the futures contract that for some reason my system said not permissioned for this because they had raised margins or something. So these kind of things happen to us too, you guys. So I don't have this on yet. I'm considering putting on is buying them. Some micro Bitcoin is 1/10 of a Bitcoin now. So whatever, depending on the depths of your pockets, you buy 1, you buy 10, whatever it is. So 46.60 looked like a spot to get in because like I said, it rejected those lows and started to move higher. I think my target on the upside is 60,000. Again, it sounds crazy because it's high, but it's Bitcoin. Bitcoin moves, probably by the time we finish this podcast, it'll have gone 5,000 in either direction. And then a stop placed below 41,900. So if you're successful, you buy it at 46.60, it's 1/10 of a Bitcoin, and you take that up to 60,000 and get out. That's a $1,340 profit. If you get stopped out at 41.90, it's 470. Because of what you just said about the EU thing, which I think is fascinating. I hate when you can almost talk me out of my thesis because you're so compelling. But from a trade standpoint, do the technicals outweigh the fundamentals here in your mind?
They do. And so here's the thing. I almost put a very similar trade on, long, similar targets before the close. But honestly, I was too busy setting up for the podcast. I didn't get into it. Because it's a 24-hour market, I'll take a look and see how the price action plays out on the cash side of things. This Bitcoin particularly has been in sort of a sideways channel from about early February till basically it broke out March 25th, right? So we trade these from a technical basis when the fundamentals are not in the way. And I'm going to say for a trade, the fundamentals are not in the way, because my thesis of Bitcoin, what I sold was that core position. I was doing the same thing you were doing, buying all the time. I sold all of that. And I'll explain why if you want me to. But from a perspective of this, we broke out of that upside channel, and then we came back and tested the top of the channel, and it held. That is a fantastic technical setup. My target on this is about 56,000. And my stop on this would be somewhere in the middle of the channel, somewhere around 41 or so, but I don't have the trade on. I'm in complete agreement with the trade you just did.
And by the way, this is the April micro contract. I don't know that I mentioned is April. That's what we're trading now too.
And again, I don't mean to say you traded it. You laid it out. I don't know if you traded it.
Yeah, no, I didn't trade it. By the time you guys see this, I may have it on. I may not, but no promises are being made. Let's talk about rates. You know, I'm a rate guy from way back. I think that the inversion of I like actually a lot what Amelia said about the inversions and have them not being as important when rates are going higher. If rates were going lower, I think it would mean more. I do think we're going into a recession, but the fact that the interest rate curve is flashing that to me is not like the main reason I'm thinking that. I just think that people are strapped. I think there is a recession for 80% of the people whose wages are not keeping up with inflation. What do you think of rates? Do you think the Fed is really going to hike 12 quarter point moves in the next 15 months, whatever the market's pricing in currently?
So I think the PCE data we had this past week did not help the Fed. I think the non-farm payrolls data did the Fed no favors at all. And I think we're going to see 50 basis points at the next meeting. I do. I don't know if they have the political strength to go through with 9 hikes, like I think Goldman called for, or 6 50 basis point rate hikes, like I think Citi called for. I don't know that they have the political stomach for that. Now, I like to say that President Biden cleared the way for them to do that by saying inflation's the Fed problem. He said that in an actual speech. So that's something where, you know, maybe with the midterms coming up, the president is basically going to lay it on the Fed. And if I were the Fed and they did that, I'd be like, okay, here we go. You asked for it. But I don't know if they're as petty and as vindictive as Italians are in the Federal Reserve. So I would say that they probably are not, but that's what I'd be saying.
Yeah, and I know, and it's funny to me because I think of a time, I think it was 2017, August of, the Fed was planning on tightening. All of a sudden they talked about tightening. The equity markets broke about 8%, and the S&P is probably about 11% in the NASDAQ. And I think it was James Bullard, although I'm not certain, just came out the next day and he said the case for tightening has changed. I'm looking at the TV going, the case has changed. The only thing has changed is the price of the stock market. The only thing that's changed is that you don't seem to have a backbone and can't face down a stock market cascading lower. And we haven't seen a stock market cascading lower. I think the Fed was perfectly fine with a 13% correction. The question becomes, would they be perfectly fine with a 25% correction? I think the answer to that is probably no. Do you think they agree with that or no?
I do. So I'm just going to go off of, past performance is not indicative of future results, but past Fed behavior is. And the taper tantrum scared them. I think they love that the market is holding up and even going slightly higher. When you look at how we finished out this week, again, it's Friday, April 1st, I call the markets flat on the week. We have the NASDAQ and the Russell slightly higher. We have the S&P and the Dow slightly lower. I call this flat. I think they love seeing this because it clears the way for them to be a little bit more aggressive. I think they need to be really aggressive because, as you and Amelia discussed, because I was listening to that interview, there's parts of this inflation issue, this inflation conundrum they can't control.
There's no doubt about it. And I think that you break it down. And I think the Fed has made a lot of mistakes. And I have zero problem saying that. I'm not trying to get any sort of job with the government. I think the government has made a lot of mistakes. I think the supply chain issues are real. And I think then on top of that, the situation in Russia and Ukraine cramped up some supply chains and fed that along as well. I'm going to lay out my trade now. And again, this is mostly technical. And I was for higher rates in the 10-year for quite a bit, and I'm still in longer term higher rates. I think there's a couple things that made me change my mind on the short term, and I sold it. Now we're looking here. These are the April micro 10-year treasury contracts. And you guys haven't taken a look at these. They're pretty cool. For historically, Bobby and I have been involved in rates a long time. You bought bonds based on bond prices, which were inverse to yield. But most retail traders identify with the interest rate and can relate to it through the yield itself. And these are
you doing this in the micro yield contract?
Yeah, in the yield contract.
I love it.
Yeah, and I like it. The only thing that I'll say about these damn things is now I have them up on my board, which I love, and I've always had, actual 10-year, bonds up too. So then I have to at my 57-year-old age, I have to be like, wait, which one am I looking at? Yields or bonds? Because it can be a little confusing, but the yields make things a little more simple, and they will in the long term. But I did sell it. I think so. So I'm selling the micro April at 2.400 and targeting a move in yields back to 2.25. And I'm stopping myself out at 2.45 on the upside. Okay, so this trade could make $150 per one lot. And some, depending on the depth of your pockets, you do a couple, gives you flexibility, whatever. And it risks $50 on the upside if you're stopped out. Again, it's mostly technical. Fundamentally, I still think you can't make the argument that rates are not going to go higher from here, because I think they are going to go higher from here. Thoughts?
I'm leaning toward higher rates in the 10-year in the short term.
Okay.
Lower rates in the medium term, and then higher rates in the long term. That sounds convoluted as shit as I say it out loud, but I would probably, I like your target on the trade because I don't think that's asking a lot. So that's what I'd say. I'm not going to do this trade, but your target is completely reasonable. The inversion of the yield curve does bother me. I disagree a little bit with Amelia. When she said the point of that she doesn't mind it with higher rates, I'm like, okay, I could see that. I could see why that wouldn't bother people. But to me, overall, it's saying that the market believes either A, the Fed's tactics are going to work on inflation, or we're going to get a slowdown, and those rates will be coming back down. So I like your target a lot. I'm not going to do this trade because I'm really neutral to potentially higher yields, but your target is completely reasonable.
Okay, before we break this up, and I have plenty of stuff on in S&Ps and in NASDAQ, but I had some short-term trades today. I sold it, but I'm mostly hedged up. Let's get can we get a broad view of that in your mind? Here you go.
So I'm a believer in stagflation coming, which people watching this don't know. It's a stagnant economy with stubborn inflation, basically. We haven't had a period of that in a long time. What is his name? LPL Financial, Ryan something or other. I can't remember his name. He's a great follow on Twitter.
Dietrich?
Dietrich, something like that.
Yeah, right.
He's a great follow on
He's
Twitter.
a good follow.
Super really smart guy.
Buddy of mine. I can't remember his name either. Yeah,
I can't remember his name. I feel bad because I want people to follow him if they don't. He put out a chart basically showing how well equities can do during tightening cycles. And I went back and I plugged in inflation and GDP growth next to his chart on my own. And what I noticed was in the 3 of the 11 periods of rate hikes that stocks didn't do well during a rate hike cycle, inflation was stubborn and GDP either was flat or lower after the rate hike cycle began. Stagflation. And I'm a believer in that. So I think the one thing that I can be sure of is that the Fed likes seeing the economy, the stock market perform like this because it clears the way for them. If they get too aggressive, I believe they will kill this rally. I do, the secondary rally that we're in. Theoretically, we're in a NASDAQ bear market waiting for a new all-time high. We're in a Russell bear market waiting for a new all-time high. But I think you and I agree that the S&P is still kind of the benchmark. Am I wrong that you agree on that? I mean,
no, I agree completely.
Yeah, to me, it's still the broad market index, and that only went into a correction. So it can go either way, in my opinion. In the short term, I think next week we'll probably see higher prices. We need a catalyst, and I don't see anything in the data, or the Fed speakers are kind of innocuous. So I don't see anything that's going to hurt us next week. And we got another podcast on Friday, so I'll let you know.
Yeah. So I agree with that completely. I think when we looked at the beginning of this year and we stared out at the landscape that was in front of us, the biggest worry that most of us had was how were stocks going to adjust to an obviously changing rate picture. And the rate picture is changing. The rhetoric is heated up. The market is pricing in rate hikes the whole way. One of the reasons we were buying stocks for all these years was because there was really very little else to buy. When you have interest rates that they're giving you nothing, it eventually forces money to walk out the risk curve, and the stock market was a convenient landing place for a lot of that. Now we're taking that equation out. So I'm having a difficult time being like a total bull. And people have accused me of being, a perma-bull over the last 10 years, and perhaps I have. And that's because the Fed was just throwing coal into the fire in the train.
I mean, all that does is make you right.
Yeah, how about that? Right. I pat myself on the back. Right, exactly. So I'm not, I don't think we're done yet. I think we could easily see a down 20% in the S&P, and I've been playing it for the short side. A trade I have on now is, like a handful of micros short against pretty wide flies on the upside, pretty wide and bullish, unbalanced fly. I don't want to get into the particulars of it. We'll have another podcast. We'll get into some cool stuff like that I think is interesting like that. But if we break, the point is, if we break, I think we break hard. If we start to move higher from these levels, I think it's more of a grind. I mean, we've obviously seen some gaps higher, which are interesting and can be terrifying if you're on the wrong side of that as well. But I think mostly we take the stairs up and the elevator down. Is that how they say it? What's that expression?
I don't remember. I always look at it as I take the stairs up and I get thrown down the stairs down. So I think going down the stairs is much more violent. So I'll agree with that sort of.
Okay, synopsis. Good. Let's just go with that then. Yeah. All right, cool. What else? You got anything else?
I got nothing else for you, buddy. I do want to mention that next week we got Kumal Sri Kumar, who's president of Sri Kumar Global Strategies and is an absolute interest rate god wizard. I can't wait to hear you and him talk rates and talk the Fed. I mean, this guy can talk about rates in the Fed for hours, and I think it'll be appropriate because we'll be approaching another Fed meeting 2 weeks after that. And then we're going to have Cameron Dawson from Field Point Private, who she's kind of a rising star to me. I mean, she's brilliant. She's on Fox all the time. She's on CNBC all the time. Now you're on Fox all the time. So you guys are going to get along great. Then we're going to have Carol Roth after that, and we'll announce a couple people more as we start to get the show going. But this is going to be fun. It's always going to be casual like this. I hope you guys enjoyed it. Thanks for having me, Jimmy, as always.
It's we've been talking for almost an hour, and I could do this if someone would just serve me a beer here. We could go another 45 minutes.
We should do that. Next week we'll do that. We'll have drinks.
I think that's a good idea, actually.
We'll end it with drinks.
All right. I want you to have a great weekend, everybody. And you guys are probably going to be seeing this after the weekend. So have a great week, and we'll talk to you soon.